So you made a big decision. You just bought your first rental property, and finally you're about to receive rent from your first tenant. Congrats, that's a big step. Now, you probably heard about depreciation, one of the most powerful tax saving tools that's available to real estate investors. But you're not exactly sure how that works. Hi, I'm Matt on EA with An and Company. In this video, we'll dive into depreciation. We'll look at what it is, how much you can deduct, and how to take things to the next level with an advanced method so you can make your investment more profitable. Let's dive in. Let's start with the definition first. What is depreciation in real estate rental? The IRS publication 946 describes depreciation is an annual income tax deduction that allows you to recover the cost or other basis of certain property over the time that you use the property. It is an allowance for the wear and tear, deterioration, or obsolescence of the property. Depreciation is the way the IRS acknowledges that your rental property will experience wear and tear over time. In real estate, depreciation allows you to deduct a portion of your rental property's value each year as an expense. For the residential property, you can depreciate it over the 27 and a half years, meaning that you can lower your taxable rental income and you can save more. The beauty about it is that you can still claim a portion of your property's value over time as a depreciation, even if the actual value of your property appreciates. Let me walk you through an example so you can have a better understanding. Let's say you purchase a rental property for $500,000. Using straight line depreciation, what you're going to do is that you divide $500,000 by 27.5 years. Then you'll see the amount of $18,181. Simply put, you're going to claim this amount every year as a depreciation for over the next 27 and a half years, which will lower your rental income. Let's say you received $40,000 of rent in 2025. Your expenses, including your mortgage interest, property tax, repairs, and operating expenses, including management fees, supplies, professional fees, etc., are $18,000. Then it gives you a net profit of $22,000, which is your taxable rental income. Now, let's say your federal and state income tax rate combined is 25%. Instead of paying $5,500 in income taxes, you will only pay $955, saving $4,545. Let's think about it this way. With that money, you can put it right back into your rental business and make an improvement, such as brand new interior paintings, or upgrading your kitchen appliances, or other upgrades that will make your rental property more attractive to your next tenant or potential buyers if you decide to sell. Or you can finally have a nice family vacation this summer. Or you can just save it until you buy your next rental property so you can expand your real estate rental business. Depreciation is hands down the most powerful tax saving tools that's available to real estate investors that many landlords and business owners out there do not want to miss out. If you're not using it, you're probably leaving thousands of dollars on the table each year. Please note, only the house. The building itself can be depreciated, not the land. So when you calculate the depreciation amount with your tax professional, be sure to exclude the land value from your property's total value. Another one, there is depreciation recapture when you decide to sell. It's another topic. I'll have a separate video for it later. Moving on. Now, you want to accelerate your deduction and maximize your profit. Let's talk about cost segregation. Instead of depreciating the entire home value, now you're going to break down your property into components with different useful lives. It'll cost you more because you will have to hire a certified public accountant to properly do the cost segregation study for you. Generally speaking, more rental properties you have, bigger benefits you can take from the cost segregation. With the proper cost segregation, you as a rental property owner, you can break down your property into individual components for depreciation rather than depreciating the entire home over 27 and a half years. For instance, appliances, your refrigerator, wash and dryer can be depreciated over just 5 years. Carpeting, your flooring, depending on the material, may qualify for 5 to 7 years of depreciation. By identifying and separating these assets, you can accelerate your depreciation, take bigger deduction, and significantly lower your taxable rental income, especially in the early years of ownership. I'm an EA specialized in helping real estate rental business owners navigate these opportunities and represent them before the IRS. Plus, I'm a real estate investor myself, and I've been utilizing depreciation ever since I started seeing my business income in 2017. So, if you are ever curious about how to take advantage of depreciation, make sure to contact us and schedule your free tax discovery call with me today. We'll walk you through the process and show you how to save more and maximize your profit. The link is in the description below. To recap, number one, depreciation is one of the most powerful tax saving tools available to real estate investors. It allows you to recover the cost of rental property over time by reducing your taxable rental income each year. Number two, over 27 and a half years, you can claim depreciation every year even if your property's market value may be going up, which means more money in your pocket. Number three, with a cost segregation study, you can break down your property into individual components and depreciate them even faster. This gives you bigger deductions up front. Okay, that brings to the end of our today's topic. You can have more information from the IRS page. I'll have that link in the description below. If you have any questions around your taxes, feel free to reach out. I'll have my contact info in the description as well. If you find this video interesting, please like and subscribe. Thanks for watching.